it's by far my favorite play in the energy space right now. A couple of things. As you said, prices have been very low, but they're starting to perk up. Now, on the front end of the curve, a lot of that has to do with this cold weather. I mean, I live in Florida. It was snowing not too far from here. This doesn't happen, right? So obviously heat demand has been very high. We've seen well freeze-offs in Texas and Oklahoma. So that's the near-term impact. But I think what's more important.
Elliott Gue, how are you, my friend?
Good to be on the show. Thank you.
Yeah, thank you for coming on again here, and we'll jump right into it. Let's first part of the year, let's get some projections here and what you're looking at. We'll start with oil, crude, if you would. Crude's been relatively stuck in a range the last 12 to 18 months.
Mm-hmm.
Yeah, you're the oil guy or my oil guy. What are your thoughts there here?
Yeah, I think the market's kind of got oil wrong. The idea towards the end of last year was that there was going to be a big glut of oil on the global market in Q1, Q2 of 2025. And, the International Energy Agency, the IEA, and other groups put out these estimates every month showing, this build in global crude oil inventories, even if OPEC plus maintains barrels off the global market. But I think there's a lot of problems with their estimates on the supply side of the equation. The most obvious is they're penciling in a lot of growth in U.S. shale oil production in 2025. And the reality is that we really haven't seen growth in U.S. shale oil production or U.S. oil production generally in something like 18 months now. So if you look at the EIA's data, that's from the Department of Energy, U.S. Department of Energy, you'll see that, oil production's really been flat for, a long time, and over 18 months. And there just isn't growth because, companies that are producing oil in a play like the Permian Basin, they're not going to grow oil production for any other reason than if the price permits them to do so. So, their costs are pretty simple. Shale is basically a manufacturing business, right?
Right.
You have a certain amount of acres in a play like the Permian Basin. The oil and natural gas and other hydrocarbons are widely distributed through that acreage, right? So producing more oil and gas and natural gas liquids is a function of spending more money on drilling and completing wells, which is capital spending, CapEx, which is the number one cost center for shale companies. They have costs related to maintaining older wells, of course, general administrative, all the stuff you have with a normal company, but their big lever, if you will, is CapEx. And obviously, they're willing to spend, if they spend more CapEx, they can grow their production, right? And they're willing to do that if the price is there. So if the price of oil is $90 a barrel, they want to spend a little more money and grow oil production, 5-6% maybe in the course of a year if they're a really good producer. But if oil is, in the 70s area, right, where it's been, or even lower, there's no incentive to do so. They would rather dial back their capital spending, to lower their costs, create more free cash flow, and leave that oil in the ground. Because, their idea being that, when oil prices are more attractive, they can accelerate their growth. All these producers have, by definition, right, a limited number of drilling spots, drilling locations. There are, of course, differences in quality between different drilling locations. So you have, prime locations that are lower cost, and you have sort of secondary locations. But when a producer is looking to drill acreage, they only have so many spots they can go to. So there's certainly no reason in the world to run through those spots at a $65 or $70 or even $75 oil price. You're going to do that when oil price is 90, 95, or 100. So the idea that is out there that, US oil production is going to grow suddenly in 2025, even though it hasn't for 18 months. And, oil prices are in the 70s, say, or even the 60s at one point, right? That's just pure fantasy. It's not going to happen. The other areas that, groups like IEA are showing growth, right? So you have Brazil, which makes some sense. You have Guyana in South America, which also makes sense because Exxon they lead a big project down in Guyana, um, that is being developed in phases, right? So we had Liza phase one, Liza phase two, et cetera. And each time they develop a new phase, oil production does go up. But then outside the United States, Canada, Brazil, and Guyana, right? They're showing something like 600,000 barrels a day of oil production growth, um, in non-OPEC countries outside those that I mentioned in 2025. That's ridiculous. These countries haven't shown real growth in oil production in like 20 years, since the early 2000s. So I don't think that I think the only reason that we would see a build in global oil inventories in Q1, Q2 is if demand were to sort of fall off a cliff, if you will. And yeah, that's certainly a possibility. But I don't see that happening absent a recession. In fact, I think the risk is on the other side. We have China, which has had very weak growth and demand lately because the Chinese economy isn't doing very well. But I mean, I think at some point, I mean, the Chinese government's already announced a bunch of stimulus. At some point, I think they announce even more, because they can't afford to sit around and wait, watch their unemployment rate go up, watch their growth sort of crumble, watch deflation, right, take hold in China. They're going to want to stimulate growth, and whenever you stimulate growth, you're going to encourage more oil demand, natural gas demand, commodity demand, copper, everything else, right? Certainly India, is another area which has seen very strong growth. So I actually think the balance is a lot tighter than, is commonly believed. At the same time, you've got, if you look at futures market commitments, from the Commitment of Traders report and and reports of that nature for Brent, you'll see that speculative length in oil, people, going long oil, speculators betting on higher oil prices, is near multi-year lows and coming off multi-year lows. And, so people are bearish towards oil. I mean, people are bearish towards commodities generally. Bank of America publishes a global fund manager survey every month. And, they were showing that, commitments to commodities generally among global asset managers that they surveyed is as low as it's been since 2017, I believe the summer of 2017. So, obviously not very bullish towards commodities in general and oil also in particular. That says to me, well, you've got people underinvested in oil, not betting on higher prices, yet the actual fundamentals are a lot better than, I think is commonly believed, and potentially much better. So I think you see oil prices generally, you got a lot of people out there projecting oil prices to be kind of flat to down this year. I think it's more likely to be, higher, and sort of towards the upper end of the range we've seen in recent years. I would suspect that, we'll see $90 a barrel oil, this year at some point, probably before the middle of the year. The only thing that could bar that, I guess, is a global recession or a but right now, I think we're seeing kind of the opposite. Um, and not just here in the US, but we're seeing something like a cyclical recovery, in, places like Europe as well. Um, and of course, as I mentioned, China. So I'm actually pretty constructive on oil. I think natural gas maybe has more opportunities for investors, but, I don't think you should ignore, the oil side of the equation at all.
Yeah. So you brought up a lot of things, and it seems like the contrarian play. Correct me if I'm wrong right now, because there is a lot of negative sentiment.
Right.
Correct me if I'm wrong. Um, the next thing that you mentioned, you talked about the Permian Basin.
Hmm.
What's your thoughts on that? Actually, I'm not talking peak oil running out of oil, but that is, and again, I want your thoughts on this. That is plateauing, or it's being projected to plateau in the next, really pretty soon in the next few years. And then what? Where are companies going to go to get the production to meet the demand, if you would?
Yeah, I think that that's a sort of an intermediate to longer term issue that will probably be crucial to the next wave of what I think is a multi-year super cycle in oil. And that is just the idea that, there's still this idea in the back of people's minds, having lived through the shale boom years, that, the US can produce as much oil as it wants, just has to go out and drill. And, to an extent, that's true. As I mentioned, if you increase capex, you'll probably increase oil production. But I think we're closer to a plateau level than is commonly believed. I like to think of it as, producers running on a treadmill, right? So they have to spend a certain amount of capital, right, to drill new wells just to offset declining production from existing ones. If they want to grow production, they have to run a little faster to keep it, above the speed of the treadmill. If they cut capex, they can increase their free cash flow near term, but ultimately that decline rate is going to catch up with them and their production is going to start coming off. So they have to drill through their inventory of drilling locations over time just to maintain oil production. They have to drill through it faster, shorten the amount of inventory they have, if you will, in terms of years of drilling inventory if they want to increase production. And so I think you're going to see a lot of producers and most of the big ones, right? Because it's increasingly consolidated in the hands of a few big players. You've got majors like Exxon and Chevron. You've got the large independents like the Diamondbacks of the world, Occidentals of the world. You don't have as many small producers out there. There are a few, but a lot of the private ones too have gotten bought up here in the last year. So, a lot of these big companies look at it as, you know, slow but steady growth in production when years are good, kind of flat production, maybe a little decline in production when prices are not favorable, and just slowly develop their inventory. They have no desire to drill through it in 5 years. They would rather have that cash flow kind of come in over time as prices warrant it. So I think what you're going to see is a plateau. So it's not going to be big surge and then drop, right? It's going to be more of like we get up to a level and we kind of hang around there. And when commodity prices are a little higher, maybe you see a little bit of growth to the top of that range of production. When commodity prices are lower, you see a little bit of a decline, but we're a lot closer to that plateau than I think the market commonly believes. If we're not already there, I think, we're probably within 500,000 barrels a day or something like that, rather than, another 2 or 3 million barrels a day of production upside near term. Um, and you're also seeing it in individual company results. One name, that strikes me as important to watch is a name like Devon, right? Devon Energy. And they produce a lot of, one of their biggest operating area is the western portion of the Permian, which we call the Delaware Basin. So wells in the Delaware Basin tend to be gassier, right? They have more gas and natural gas liquids content. But what we've been seeing is Devon drills through its inventory, their amount of oil they're producing as a percentage of total output from their wells is declining. And wells are becoming gassier and natural gas liquids more rich, natural gas liquidy, whatever you want to call it. And obviously those hydrocarbons aren't oil. And so I think that's an issue as well. As these companies drill through their inventory, especially in places like the Delaware Basin, will we see oil production grow at anything like the rate of overall production growth, right? So barrels of oil equivalent coming out of the ground, which includes natural gas liquids, all of that will grow and has been growing, but the actual barrels of oil growth, the actual oil, is growing at a far slower pace. And that's an issue as well. In terms of, where do we go from here? Well, there isn't another Permian Basin in the United States, right? You have, the Permian Basin, the Delaware Basin, and the Midland Basin. These are, these are going to be your best plays in the United States in terms of shale. And there really isn't another play of that size out there. Yes, there are some other plays out there which will continue to contribute, like the Bakken Shale, for example, but they're not going to show anything like the growth, probably seeing declining production already in many cases. You have sort of some second tier plays like the Scoop Stack in Oklahoma, for example. It's a very nice, profitable play, a little higher cost structure. But again, it's going to be hard to show growth out of the scoop stack without growth from, or without at least steady production from the Permian. It's going to be hard to push overall oil growth. Outside the United States, there are a few promising plays like Guyana. I mentioned Exxon's project there. Not many years ago, they were getting in 2020, 2021, they were getting attacked by this, activist fund who did not like that they were investing so much capital in oil exploration and development. And they wanted to divert capital to, alternative energy. And, that was a bad idea. That would have been a bad idea. Fortunately, Exxon continued to invest in Guyana, and it's turned into this world-class play that's extremely profitable even at low oil prices. But again, there are not many other plays out there like that. OPEC does have some spare capacity, particularly, Saudi Arabia, some of the other big Gulf countries do. But again, it, even though it sounds like a lot, say, Saudi Arabia has 2 million barrels a day of spare capacity. I don't even think it's that much, but let's just say, it doesn't take the world very long to run through that if production from other countries is falling off. And Saudi Arabia, is going to struggle to grow its capacity to produce oil without massive investment over the next few years. So yeah, I think the answer to your question is there really isn't anything that can offset, an outright decline in production from the United States, and really even just a flattening of production from the U.S., where the U.S. continues to produce at sort of this 13.5 million barrel a day area. That still has challenges because you have to have, if you have overall growth worldwide in demand, which I think you do for decades to come, honestly, it's going to be difficult to meet that demand with the U.S. flat. The U.S. shale has basically enabled all this growth in demand globally over the last 10 years. And if that is sort of petering out, not petering out, but plateauing for a long period, it could be 20 years plateau. It's not an immediate decline, I'm saying, but that has obviously an impact on prices. Prices have to be much higher to incent companies to go out and drill in these more expensive plays.
Okay, so you just answered about 3 questions, but
Sorry about that.
sorry, because I'm still going to ask them, but you already answered them. But
Okay.
I want to ask them is like, okay, and I say this also very agnostically, politically, okay?
hmm
Drill, baby, drill.
hmm
That is where are they gonna go? Drill, baby, drill, right? I guess that is more of a statement than a question, but I do want you to comment on that. And that's really was my biggest question for you with oil is like, where to drill? Where is the production going to come from with everything you just said? And you just presented the same question. Where's the production going to come from? Right.
Right. Yeah. Drill, baby, drill. I think this is another thing that a lot of people misunderstand. Um, the idea that, or first of all, the United States, it's not a socialist country. Right? We don't have a national state-owned oil company. There are countries out there that do, including countries that aren't socialist, but there's a lot of countries in the world that have national oil companies that are partly or fully state-owned, like
Sure.
Saudi Arabia, for example, right? And
Because
then the government can direct that company to drill more, to produce more, to invest in capacity, to not drill more, to not produce more, whatever. But you can't do that in the United States. The United States is a private industry, which means that, and that's why we produce more oil than anyone else in the world, frankly, because, it's not like the government invented shale production, right? That was invented by pioneers in the shale industry, Mitchell Energy back in the day, had names like, Pioneer Natural, just got acquired by Exxon last year. So, because the government doesn't order oil companies to do this or that, they can't tell them to go out and produce more oil. The only reason why a private company is going to produce more oil and gas is if the price is high enough to incent them to do so. It's a price signal. That's how free markets work, right? If the price of something goes up, it encourages a supplier to supply more. and a consumer to consume less. It's as simple as that. And it's been as simple as that really since the dawn of time in every commodity market. Drill, baby, drill. What does it really mean? Well, the government can't force companies to produce more, but it sure can frustrate companies, right? And maybe cause them to raise their costs, cause them to produce less at every price point. For example, early days of the Biden administration, he came out and put a pause on federal drilling permits. Now, a lot of people sort of overestimated the impact of this because a lot of companies, for example, in Texas, there are no federal drilling permits in Texas. So it didn't matter. But for some companies, this was an issue because though they had enough permits in hand to handle their production over the next couple of years, after that, it could have become an issue. And it could have resulted in a decline in oil and gas production. It was struck down by the courts. Last year, on the gas side, right, the Biden administration put an LNG export permitting pause in place, right, which basically meant that you couldn't get permits from the government to build new liquefied natural gas export facilities. Didn't have any immediate impact because a lot of companies already have permits in hand, already under construction, didn't apply to them. But for projects that people were looking at in 2029 or 2030, which kind of seems like a long time away now, but it's not really, right? That's how long these things take to permit and build. It was an issue. Little things like that. Also things like, rhetoric, talking about, punishing the industry for, emissions of carbon dioxide. Not little, but sort of black clouds over the industry. And I think what drill, baby, drill is best, right, is that it means we're going to remove a lot of those obstacles from the industry. So a lot of those black swan risks that were out there, such as some sort of climate bill that would actually really have an impact on oil and gas production, are no longer as much of a threat or any threat. The President Trump on the first day in office, lifted the LNG permitting pause so we can have more LNG export facilities. Obviously, he's not going to put a ban on federal permitting in places where that's an issue. So things like that, just removing those headwinds, some of which were more psychological than anything else, but that does make it easier for the industry to grow production when it's warranted and pull back on production when it's not warranted. And I think just removing those legal barriers, removing those regulations does help, but it's a more subtle change than suddenly expecting 1 or 2 million barrels a day of new oil production. It's completely ridiculous. Listen to any conference call from any of the oil majors or any of the independents and listen to why they talk about their capital spending plans. It's always about, here are our costs, right? Here's the price of oil. Here's the price of natural gas. Here's the price of a barrel of natural gas liquids, ethane, propane, et cetera. Here's how many hedges we have in place. This is what we're going to spend, and we're planning to grow production 1%. Let production decline 1%, whatever. It's always based on the economics. Remember who owns the US energy industry. It's not the government, it's you and me and investors as a whole, right? So what do we want out of these oil producers? We want cash flow, right? We want free cash flow. We want dividends. We want share buybacks. I don't care whether the company produces 1 million barrels a day of oil or 1.25 million barrels a day of oil. I only care about how much money they make out of that production. Management teams know that. They know that if they went out and splashed out on CapEx and drill, baby, drilled, right, without support from the commodity, their stock price is going to go down, which is all on it. Let's be honest, is all anybody cares about in a free market system, right? Because the stock price is the value creation for the owners of that stock or equity, right? So I think drill, baby, drill will have an effect on the margin. I think it's probably going to have more of an effect, honestly, on natural gas because of this LNG export opportunity. The idea that this is going to mean a decline in oil prices in 2025, to me is absolutely ludicrous and has no basis in reality. And I think the market it's starting to dawn on the market that that's the case. Um, certainly, you know, removing regulatory red tape on the margin will reduce your costs a little bit, but not enough to cause this big surge in production. Current oil prices, $90 a barrel, $95 a barrel is a different story.
Right. Got it. You mentioned before we go there, you mentioned natural gas, but before we go there, there are a few companies that you really like. They can be big names, medium names, small names. It doesn't really matter, but that you just give to our listeners that, yeah, some of your favorite names and companies just to come
Sure.
to.
On the oil side, I mean, the big names, my favorite is
Yeah.
ExxonMobil, not the most creative pick in the world, but symbol is XOM, obviously. But, what I like about them is they have remained, they stuck to their knitting, right?
Mhm.
Whereas a lot of companies, especially the European majors like BP, started investing in solar, wind, and other alternative energy projects. And Exxon has too, to an extent. But Exxon stuck to continue to invest in its core oil and gas E&P business, exploration production business. And that's what they know best. That's what they've been doing for all these years, right? And they're very good. They're very good at investing when prices are low, commodity prices are low, getting good deals with foreign governments, finding, developing big multi-year, multi-billion dollar projects like they've done in Guyana. I admire them for that. They stuck to their knitting. And as a result, they have the best production growth profile of any major in the world, of the big names. The European majors, a lot of people say, BP is a great value. Well, it is cheap, but it's cheap partly because they just don't have, they didn't get the returns they expected from alternative energy projects. And as a result, and they don't have the investment out there to grow their upstream business, their oil and gas production business. So that's not a very good place to be in the current environment, where you've transferred capital spending from an area where you have a lot of expertise, ton of expertise, and very high margins, right, to an area where you don't have as good returns and you don't really have that much expertise. I mean, a lot of BP's projects, they didn't even run, right? They were investing in a project run by somebody else. So not to just slam on BP for however long, but Exxon is kind of unique in the energy industry. Chevron is another good one, but Exxon's my favorite on the big names. Smaller names, I like companies that that are holding on, that are producing a lot of free cash flow, even at moderate oil prices, and are also holding or growing their oil itself, their oil production itself. I mean, look at a name like EOG Resources. This company is famous for going into existing plays and finding like little plays within the play, you know, um, profitable niches within these larger plays. And they're a very well run company. They've always been focused on sort of the exploration, the actual sort of engineering side of it, the operation side of it, which I respect a lot. Great balance sheet, so that would be an example of a name I like here. A lot of these names have popped up a bit here, but I think that there's considerable upside, um, both this year and over the intermediate to long term, because even though they may have gained a lot near term, you have they're still cheap in the broader sense of things. And if you look at the energy industry as a percentage of, say, the market cap of the entire S&P 500, it's still tiny. And when you consider how important energy is to the US economy, to the global economy, just ask Germany, right? Energy
Right.
costs go up a lot. You have problems on the manufacturing side, the industrial side, everything. So, I think energy is going to have to become a much bigger industry to fund all this capital spending needed to grow and maintain even global oil production.
Yeah. You mentioned Devon Energy at the beginning of this talk. Is that more a play on natural gas, or would you say that's still a play on oil?
They're considered an oil play. We have it as a hold in the service. I think that I mean, they have their biggest operation is the Delaware Basin. I think it's something like 60% of their capex, but they have a lot of other plays. Another one is the Bakken Shale, which is in North Dakota. And they recently made an acquisition there. I think they closed it in September and they announced it in July. It's a private company called Grayson Mill. And Grayson Mill has acreage in the Bakken Shale. And what's interesting to me is that they've seen this decline in oil production from the Delaware Basin, which is their core play. That's as I said, the western portion of the Permian in New Mexico and Texas and West Texas. And so by buying Grayson Mill, the average well in the Bakken it's not as profitable as the Permian, but it has a much higher oil cut. So you're going to get more oil production out of each well. It's harder to grow production, but you get more oil. And I don't think the Grayson Mill acquisition was a bad deal per se, but I find it interesting and a little concerning on the margin that Devon is having to kind of make up for their declining oil percentages in the Permian by making a deal in North Dakota
Yeah.
just to increase their oil production. I'm not saying Devon's a bad company. I don't think it is. There are some concerns about the debt they took on to fund this deal. I don't think that's a concern in terms of financial stability because the company has such strong free cash flow. They will continue to return cash flow to shareholders in the form of a regular dividend and buybacks. They're pulling back from their variable dividends, which was something a lot of investors found attractive for years, in favor of more share buybacks. I think that probably makes sense given how cheap Devon stock is. But I look at that, I would rather see a company that is their core operating areas. They're showing kind of steady or at worst sort of a slight decline in the oil cut, not where, a couple years ago, 51% of oil equivalent oil equivalent production out of the Delaware Basin for Devon was with actual oil. Now it's, I think, 46% oil,
Yeah.
and the rest is natural gas liquids and natural gas.
Yeah.
And natural gas in, the Western Permian is cheap. In Q3, which is their last report, even after hedges, they got 84 cents, right? 1,000 cubic feet. That will improve because there's a new pipeline called the Matterhorn pipeline that moves natural gas from West Texas to Katy, Texas, further east, right? But still, it's still going to trade at a discount. And, if you want to play natural gas, I would rather go with a pure natural gas producer in some place that they can access the Henry Hub and all this LNG export capacity we have coming on stream.
Yeah, and so let's talk about natural gas, but real quick, my thoughts on Devon. I thought you brought up that acquisition. I thought they need to replace their production. I thought these were my thoughts only. I'm not speaking for you or anybody else, but I thought that was going to be I was concerned too because they see production going down and I see Devon more as a natural gas play now. But anyways, just my 2 cents. But let's talk about natural gas here. Natural gas has been at a lower trading range, if you would, which was surprising to me with all that's gone on in the world the last couple of years. What are your thoughts now moving into 25? And do you think certainly looks like we've seen a floor on a bottom on natural gas? And if you want a hated energy commodity, it seems like natural gas would be in it. So tell me your
Yeah.
thoughts.
Yeah, absolutely. I would say I've been telling a lot of our readers that I think 2025 is going to be the year of natural gas. It's by far my favorite play in the energy space right now. A couple of things.
Yeah.
As you said, prices have been very low, but they're starting to perk up. Now, on the front end of the curve, a lot of that has to do with this cold weather. I mean, I live in Florida. It was snowing not too far from here. This doesn't happen, right?
Yeah. How
So
much
obviously
weather
heating
has
demand has been
nice
very
rain?
high. We've seen well freeze offs in Texas and Oklahoma. So that's the near term impact. But I think what's more important is to look farther out on the curve. So if you look at the natural gas futures curve, what I'm talking about is their futures market that you can arrange for delivery of natural gas in every month of the year. You know, February of this year, June of this year, December of this year, December of next year. And all those contracts trade at different prices. And what we've seen is the back half of the curve has been sort of gradually gaining steam for some time. So when gas prices were depressed, you saw on the front half of the curve, gas prices, average gas prices were for early this year. This is before this recent rally. We're down in the low twos, but towards the end of this year, we're more like 350. Okay.
Mhm.
Now it's all shifted up. Right. And why is that happening? There are two reasons I see. First, which I would say is more the longer term issue or rationale, is that you have very strong growth in electricity demand here in the United States. A lot of that has to do with artificial intelligence and data centers and things of that nature.
Mm.
I saw my colleague at Energy and Income Advisor has covered the utility industry for many years, and he had this stat where in 2020, 1.5% of U.S. electricity went to run data centers, right?
Mhm.
Server farms. What by the end of this decade, it's going to be 9%. That's a lot of
Wow. That's a lot of growth.
That's a lot of growth. We
Yeah.
haven't seen electricity demand on an annualized basis grow at the current pace since the 60s and early
Yeah. Sure.
70s.
Sure.
Think about that. Oil
Yeah.
demand isn't growing at the rate we saw back in the 60s when people were getting their first cars, right? And all that. Um, it's a big shift. And I
Mhm.
think it's going to continue because, the US wants to be a leader in this. And these chips, these artificial chips, artificial intelligence chips and server farms take a lot more power than a conventional server farm, multiples. I think it's 300% of the electricity or something, somewhere around there anyway. I saw the stats the other day. So that's one thing. And that's going to be a theme for years. Okay. On the flip side of the equation, uh, international demand. So back in 2022, we had the Russia invasion of Ukraine, right? And we saw gas prices spike in Europe because, the pipeline moving gas, one of the major pipelines moving gas from Russia to Europe was blown up.
Yep.
We saw disruptions in Russian supply. Some European countries were getting 70% of their gas supply from Russia. Um, just sort of a rule of thumb. You don't want to have your supply of anything, right, concentrated that much. You're much better off as a country, right, getting your supply from 10 different countries rather than getting 70% from one source. Because if something goes wrong with that one source, you're really in a problem. And that's
Mhm.
exactly where Europe found itself. Price of gas spiked. And I remember talking to a lot of people, conferences, various places, readers, and they're saying, oh, well, the US is going to ramp up exports of liquefied natural gas to offset that because the price of gas here in the US was much lower than in Europe. So in Europe, it was as much as, around $100 a million BTUs, right? And here in the US, it was 10, right?
Mhm.
So the idea was, well, this is awesome because we can take this gas that we produce in the US, put it on a tanker, an LNG tanker carrier, move it to Europe and sell it for a much higher price, 10 times, 5 times as much. Problem with that is that you can't, there's a fixed capacity to export gas. And these are big projects. I don't know, some of your listeners may have gone down and toured on the US Gulf Coast and seen these things, but these are large scale developments. They're like refineries type size. And they're multi-billion dollar, multi-year deals, right? Where you have to arrange financing, get permitting, actually construct the thing, which there's often delays. One
Yeah.
major facility coming on stream at the end of this year, Golden Pass, run by Exxon in Texas with Qatar Gas, has already been delayed over a year
Yeah.
because of the bankruptcy of the company involved in constructing it.
Yeah.
So you can't just ramp up LNG exports. And the problem we had in 2022 was that the US was already basically bumping up against the maximum capacity to export. There were a few projects trickling on stream at that time. Once we got to that 12 and a half billion cubic foot a day range, we were right up against the wall. There was no scope to grow gas exports more than we already had. So the idea that this was going to be an immediate boon for US gas producers was premature because it takes years, as I said, to build these things. The time is now, okay? Between the fourth quarter of last year, 2024, and the first quarter of 2026, so a year from now, we're going to see more than 4 billion cubic feet a day of new LNG export capacity come on stream in the United States. That
Wow.
includes all of the expected delays I already talked about Golden Pass, and there have been others. And all of these projects are basically on the Gulf Coast, Texas and Louisiana, right? And so we're going from 12.5 billion cubic feet a day to 16.5 billion cubic feet a day. By 2028, 2029, it's going to be north of 20 billion cubic feet a day.
Almost the double.
Right. Over the course of a very short period of time. Now, these are not new projects, right? These are projects that they started construction on, back in 2019, 2020. So these are projects that have been in the works for some time. There are some new projects now that will probably move through the pipeline now that the permitting pause has been lifted. So you have strong electricity growth, demand growth. Where is that from AI, right? Where is that going to come from? You could burn more coal. That's probably wouldn't be the most popular thing. Coal plants are being closed. You could put up more solar and wind capacity. On the solar side, that's relatively easy to permit, very fast to build, but it's intermittent, right? And there's nowhere near enough storage in the United States to offset that intermittency. It's too expensive as well. So solar can be a tiny portion of the solution, but you can't run an AI data center off solar, right?
Right. Not December, January either.
No. And, at night and stuff. And this has to be 24 hours a day, 7 days a week, including the night, right?
Right.
So, gas is one of the only things out there that can be built very quickly. Now, nuclear is a longer term solution. You're not going to be able to build a brand new nuclear plant next year. It's going to take time to permit, develop, raise the capital, all that. But we can do that with gas. You can build a natural gas plant relatively quickly. The permitting is relatively easy, far more environmentally friendly than coal, right? And it's not intermittent. So I think you're going to see gas get more than its fair share of this new demand from AI. At the same time, you've got European economies have been decimated by this energy crisis. Germany is the one I always like to bring up. Don't mean to pick on Germany. I love Germany, but what do you think of when you think of Germany? You think of manufacturing prowess, right? Building cars, but not only that, building industrial machinery.
Right.
Their industrial production has been falling since 2017. And a lot of that has to do with the very rapid rise in the cost of electricity and natural gas in Germany. A while back, they wanted to host a snap election. And it turned out they had to delay the election because they didn't have enough paper, for ballots, because their paper industry is basically closed down due to the high cost of electricity, energy. That's kind of a ridiculous example, but you get the point. Look at a country like the United Kingdom. I lived there for years. But they're struggling with electricity costs in the home that are 4 and 5 times the US average. People can't afford to heat their homes this winter because of the high cost of electricity. They need more gas. They may tell you that that they can do it all with solar and wind, but the facts are what the facts are. And they need more gas, especially with Germany shutting down its last nuclear plant last year. They need it. And a lot of that's going to come from the US. And I think that you're going to see US exports of LNG pretty much bump up against that maximum capacity for years to come. That's a lot of demand growth. So I think natural gas in the short run, if you're looking at the February or March futures or something of that nature, you could even see it come down. Eventually this cold snap, hopefully, this cold snap is going to end. And, I can walk outside in shorts again in, February in Florida. But, so that some of that, the high heating demand we're seeing around the country right now, the well freeze-offs in Texas and Oklahoma, it will end, right? And so prices may come down. They've gotten up there pretty fast. But the long-term curve, we're now seeing prices, $3.50, $4 average for the back half of this year and into next year. A lot of these gas producers in the US, names like Expand Energy, EQT, and we can talk more about those specifically in a minute, but they can produce a ton of free cash flow, 350 and 4, and they're already locking those prices in using their hedging. So, yeah, I think natural gas is a tremendous opportunity this year. I'm not trading the actual gas futures or these ETFs that track gas, like the US Natural Gas Fund, but the producers, because it's all about the free cash flow. And if they can produce free cash flow at 225, which some of them can, they can produce a ton of free cash flow at 350 or 4. So you don't need to see a big rally in gas. You're going to see that inflating free cash flow, dividends, share buybacks, variable dividends from the likes of Expand. I think he's going to drive a lot of upside and create a lot of shareholder value.
Yeah. Well, let's talk a little bit about that. Give us a couple of names, bigger, smaller, intermediate, that you like here going into 25.
On the producer side, again, I would look at a name like EQT and Expand are my two favorite names. Let's talk about Expand first. Expand Energy, the symbol is EXE. Many of you may never have heard of it because it used to be called Chesapeake Energy,
Wow.
which is more familiar.
Right. Okay.
Yeah, Chesapeake's been around for a while. Anyway, Chesapeake purchased Southwestern Energy. The symbol there was SWN. They closed the deal in early October of last year. They're now the largest natural gas producer in the United States, the largest shale gas producer in the United States. They have operations in two areas: the Marcellus Shale, which is Appalachia. So it's going to be like Pennsylvania, West Virginia, places like that. Ohio too, right? And the Haynesville Shale. The Haynesville Shale is centered in Louisiana. Now, I like both of these plays for different reasons, right? The Marcellus Shale is the cheapest gas that you'll find in the United States. It's a stacked play, kind of like the Permian, and those wells are cheap to drill and produce a ton of gas. Some of the better producers in that region can break even free cash flow basis, even with gas, sub 2, which is very, very low, right? That's, multi-year lows. The problem, if you will, with the Marcellus is where it's located. As I said, it's in Appalachia. So most of that gas has to be piped down to the Gulf Coast.
Yeah.
For some reason, again, I won't drive into the third rail of politics, but New York doesn't allow natural gas to be brought in via pipeline from the neighboring Pennsylvania, right? They actually get it via LNG tankers, just like the Europeans, but we won't go into that. Okay. So a lot of that gas ends up going south to Louisiana and Texas to be in an area of the country where obviously there's not a lot of demand for natural gas in Western Pennsylvania and West Virginia. These are relatively underpopulated areas. There's not a lot of local demand. So that gas has to move south on pipelines to places like Louisiana, Texas, down the East Coast, states like here in Florida, where we use a lot of gas, right, to produce electricity. So the problem is that there's a fixed amount of natural gas pipeline capacity. They're not going to be a whole lot. There was a Mountain Valley pipeline was approved by the special act of Congress last year and put into production or put into use, but you're not going to see a lot of new capacity coming from the Appalachian region down to the Gulf Coast. So companies that have good acreage in the Marcellus can produce gas cheaply and have existing pipeline capacity are kind of in the catbird seat. They can sell that gas at a good price realizations. The Haynesville Shale is a little bit more expensive to produce, quite a bit more expensive to produce. Most producers there probably need 3+ gas easy to produce free cash flow, some more. But Haynesville is located in Louisiana. Louisiana is very close to, the Louisiana Gulf Coast, right, as well as the Texas Gulf Coast. So the LNG corridor.
Mhm.
And so prices there are Henry Hub is in Louisiana. So the price you see of natural gas, they can realize very close to that price. And they only have to move that gas a short distance to get it to these LNG export facilities.
Mhm.
So I like producers that have exposure to both regions. Expand is an example of that. They have the low cost production in the Marcellus, not a lot of growth because of the lack of pipeline capacity, but at, $3.50, $4, they're producing a ton of free cash flow there, low cost. Then they have the Haynesville, more growth potential there in terms of production growth,
Mhm.
and the demand coming from LNG exports, and they can produce copious free cash flow at 350 or 4 from that region. So they can kind of adjust accordingly. If gas prices rise, they can push more capex to Haynesville, grow their production, and sell into that market. If gas prices are low, they can cut Haynesville and maintain cash flow via the Marcellus, which is a lower cost play. So I like them for that reason. Um, I also think that, by acquiring Southwestern and becoming the largest gas producer in the U.S., they're probably going to be added to the S&P 500. If you're a big fund manager looking
Yeah.
to say like I want to own gas, what are you going to do? You're going to probably pick one of the larger gas producers and say that's your play, right? Expand is that. EQT is a Marcellus producer. They're the lowest cost gas producer in the US. I mean, it depends upon exactly how you measure that. Um, Obviously, some of the Permian producers, they produce gas as a byproduct of oil production. That's different. There are also some producers in the Marcellus that produce a lot of natural gas liquids, which earns a higher, um, it's worth more than gas itself. But EQT is a pure play gas producer, is, certainly one of the lowest cost players there. Last year, they bought their midstream unit, which was previously a separate company. And they have very good midstream operations, which is very important there. So pipelines, gathering pipelines, all that's needed to move gas out of Marcellus to market and get a good price realization. So yeah, I think both of those names are a great way to play gas this year.
Excellent. So let's move on real quick. Let's do this. I say this I want to be respectful of your time. But to uranium, that's probably the third leg of the energy stool, the way I see it.
Yeah.
Um, Comment about that. It looks like uranium settled down here, low to mid 70s area here. What's your projections of uranium really for in 25? And who do you like in the uranium space?
Yeah, the longer term option in uranium and in nuclear power is strong because it is a carbon free source of it's pollution free. Forget carbon dioxide, but all the other pollutants that come out of coal plants, gas plants, even uranium, you avoid that. Nuclear power, you avoid that. I think that a lot of countries around the world are probably looking at the experience of, for example, Germany and saying, yeah, I don't want to do that. And maybe deciding that closing your nuclear power plants down and, building a bunch of intermittent power probably isn't the best move.
Mhm.
Um, and it actually increases your carbon dioxide emissions, increases your pollution. It also dramatically raises your costs. So I think nuclear power has a very profound future. The only problem with it, if you will, is that it takes a while to bring more nuclear capacity online. So, it's very easy to sit here and say, well, the U.S. should build a bunch more nuclear power plants, um, and get more power from that, and shut down other sources of power. And here we go, always on baseload power. But it's not realistic. It takes time. You're going to see more deals like what we saw between Amazon and Constellation Energy, right? Where they're going to try to reactivate older nuclear power plants that have been shut down or aren't operating or need a life extension, right? They're going to restart those or extend the lives of those. And you're going to have companies like Amazon, right, buy all the power from that nuclear power plant because it's reliable, always on. It meets their carbon dioxide emission goals and all that. It's a win win. But again, it's going to take time to build out capacity. Um, yes, there's some talk of smaller nuclear reactors and technology of that nature, but it's still a ways off. The other problem you have with a major project like nuclear is capital costs. So, with gas, there's not a whole lot of upfront capital cost to build a new plant. Yes, you have to build it, but most of the cost of operating a gas plant is the cost of the fuel. With nuclear, most of the cost, the fuel is nothing, right? I mean, it's a tiny percent. The cost of uranium is less than 10% of the cost of nuclear power. I mean, it's nothing. It really is the upfront capital cost, the billions of dollars you need to spend to get the permitting, to build the plant. These are big projects. And of course, um, when you have a big capital project like that, you probably need to borrow money. So high interest rates is not good for uh, capital intensive sources of electricity generation. Wind is another example. You've seen these wind projects get canceled because offshore wind is a capital intensive industry. So that's another short term struggle for them. All that being said, I think you're going to see, you've seen countries like Japan that were planning to get rid of all their nuclear capacity not long ago after, to be honest, they had a nuclear accident, right? In the Fukushima disaster, 13 or 14 years ago, I believe. But they've restarted plants. They're recommitting to nuclear because they realized they can't meet their needs in Japan with solar and wind, and they don't have any natural resources to speak of. I think you're going to see it in Europe too, right? Countries, France, for example, which gets a lot of nuclear power, maybe recommitting to the technology. So there, it's one of those things that I think you're going to see growth in demand. I think nuclear is a growth area, but it's probably going to take a little longer than some of these other themes I'm talking about, particularly on the gas side. The only play we're recommending in uranium and nuclear power right now is Cameco. Trades here in the US, symbol CCJ. Canada, I think it's CCO is a symbol. They're a large producer of uranium. They also have some of the, conversion capacity. And they are signing longer term deals covering their production at attractive rates. And I think they'll continue to be able to do that over time. I think that it's more of, if you remember back, when I first started covering the energy markets was the late 90s, but in the early 2000s, there was this boom in uranium, if you remember. And these stocks did really well. And you had all these tiny little uranium companies showing up at all these investor conferences around the US. And you had this kind of like bubble and then this collapse when all that new production came on stream from Kazakhstan. Right. I think this is maybe going to be more of a slow burn cycle where, we have these companies, they're going to see ups and down cycles around, but it's going to be more of a gradual uptrend over time. And right now, I like Cameco to play that. When we get to this phase where there's a sort of more of an immediate upside catalyst, that's when I would start looking at some of the smaller names. Another way to do it is there's an ETF out there, URNJ, I think the symbol is, that owns a kind of a swath of these smaller producers and uranium exploration companies that can do well, particularly if you're shorter term oriented in these periods where nuclear is really hot. But right now, for our longer term services, we like Cameco, and we've been recommending it, buying it, particularly on dips. We saw it dip quite a lot actually towards the end of last year, early this year, which turned out to be a good opportunity. It's back up in the 50s now, and yeah, I think that continues to be a great way to play it. Cameco has its faults too. They've had some issues with production in the past, going back 15 years. But I do think it's a high quality senior name in the space and a good way for, if you're interested in the longer term uranium story, but don't want to get bogged down in sort of the cyclical ins and outs of this industry, I think that's a good way to go.
Got it. Elliott, I want to, how if people want to do business with you, they're become a fan of your work as I have. I highly recommend you, and I did say recommend. How do people get in touch with you and read your work and do a deep dive with you and energy stocks?
Yeah, absolutely. Well, we have a service we've been running now for about 13 years called Energy and Income Advisor. The website is energyandincomeadvisor.com. And that focuses solely on the energy industry. I co-run it with my colleague, longtime colleague Roger Conrad. We cover everything from oil to natural gas to renewable energy as well. Midstream companies, pipeline companies, things of that nature as well. We have a model portfolio, and we have an issue every month, as well as more frequent flash alerts and updates. So that's a great place to go if you're looking to sort of test the waters, as it were. I do have a Substack, substack.com. It's called Free Market Speculator. And I don't solely cover energy there. I also cover, my outlook for the economy, but I talk a lot, to be honest, I talk a lot about commodities and energy commodities in particular in Free Market Speculator. Nice thing about that one is that there's a free version which encompasses most of my commentary. I do have a paid version that we have a model portfolio. We do some trading, options trading, and things of that nature. But if you just want to read my thoughts on energy, my thoughts on specific stocks, you can get a lot of that for free over on Substack at the Free Market Speculator Substack. And you can just put your email address in there and get the commentary delivered for free, or just read it for free and not put your email address in. So that's a great way. I also love to answer questions on there. So if you have a question, just put a comment in there on any of the articles I have up there, and I'll get back to you. I love to field questions from readers for a number of reasons, but one is that, frankly, questions from readers or listeners are a great way of understanding what people are worried about, and what they maybe aren't worried enough about, right? That I can cover in future issues. So it helps me out, and hopefully it helps you out to get your questions answered. So
Excellent. Well, I'll put links to both of these in the show notes, both on the YouTube channel,
thank
as
you.
well as you're welcome, as well as the Apple podcast and the Spotify podcast. Elliott, it's always just a fantastic pleasure having you on. I try to get you on every 3 to 6 months. It's been more towards 6 just because of our schedules, but I just can't thank you enough. I love your insights, and yeah, and you have provided great value to everybody that listens to you. So I just want to thank you.
Oh, thank you very much for having me on. It's always a pleasure.
Yep. Take care. Thanks, Elliott.